welcome to Cigars and Syndication, where we're passionate about real estate and we're passionate about cigars. We're going to continue talking about the Silicon Valley Bank situation, and we're going to dig into the regulations a little bit, and we're going to keep enjoying this LFD 25th anniversary smoke. I'm Robbie Rogers, and I'm here with my co-host Jay Noor.
Hey, thanks, Robbie. I'm Junaid Noor, and welcome to part two of What Happened with Silicon Valley Bank. So let me just recap a little bit. Silicon Valley Bank was founded in 1983. They went public in 1990s, and they started focusing on startups. Mainly, they were known as Santa Clara Valley Bank. They changed their name to Silicon Valley Bank, and they started focusing on startups and all the companies that were backed by venture capital. So they didn't have a lot of loans and debt that they needed to provide for a lot of these companies. All of these companies were equity based, and what they did was that these equity based companies would deposit money with Silicon Valley Bank.
Well, and that kind of leads up to fast forward to the end of 2022, and they reported this 1.8 billion dollar loss.
Unrealized loss.
Unrealized loss.
Yes,
and
that's
and
important.
and then from there, what was the reaction?
So just for our viewers to understand what an unrealized loss is, a loss that you report on paper, but it's not an actual cash loss because you haven't actually sold the securities, but because the securities have dropped in value, it's unrealized. So what happened was that they reported this 1.8 billion dollar unrealized loss, and people started panicking, and so they said, "Hey, whoa, wait a minute! We're going to raise 2.25 billion dollars in new capital. We're going to issue shares, and we're going to raise this capital, and we're going to cover these losses, and we'll all be fine. Everybody will be good." And so they went out in the market. They tried to raise this 2.25 billion dollars, and nobody wanted their shares. Nobody wanted their stock.
Well, for everybody that watched the first part of this episode, thank you for coming back. And you ended that one, the first part of this episode, with a question of what could they have done to prevent this? And, it kind of seems like they've had 6 increases from the Federal Reserve Bank. And for the foreseeable future, we're going to have a few more increases. And did they just sit there and watch this happen? Are there things that they could have done in the background?
So one of the other issues, and I mentioned in the first episode that there were 2 issues that we needed to discuss. One was the accounting issue, and one was a regulatory issue. So now we're going to come to the regulatory issue. So in 2008, when Dodd-Frank was passed, banks had to meet a certain stress test, and they had to meet those stress tests every quarter. So government regulators would come in, and they would basically run models, run different types of forecasting numbers, and say, okay, if you keep lending at this rate, then you'll run out of capital by this X date. And therefore, the regulators would basically say, you need to maintain as a bank a certain amount of liquidity in order to be able to meet the depositors' withdrawals. And if you remember in 2008, we didn't really have any runs on the banks here in the United States, but Ireland, if you remember watching Ireland, they had runs on their banks, and people were standing outside waiting, to get their money. And everybody wanted to withdraw their funds because they just felt that those banks were not liquid. So that was 2008.
So you've got the regulations in place and the stress test in place. Where did the failure occur? Why wasn't this something that was seen? Why wasn't this on the forefront that this was happening?
So Dodd-Frank was passed in 2008. All banks were required to meet minimum capital requirements, had minimum capital requirements, and they had these stress test requirements. Well, in 2018, President Donald Trump signed a law increasing the threshold. So if the bank had more than $250 billion in assets, they no longer had to meet those minimum threshold requirements. And so basically, What he basically did was he exempted all of the regional banks from having to meet the stress test requirements. So Silicon Valley Bank is a regional bank.
So they didn't have to report except annually.
Right. And this is one of the reasons why everybody, you know, everybody's saying that this is not going to be a nationwide systemic failure, because the larger banks, the JP Morgans and the Bank of Americas and, you know, the Citibanks, they all had to meet those stress test requirements. So therefore they're still all okay. But because Silicon Valley Bank no longer had to meet the stress test requirement, they can actually go and buy more and more treasuries without having to keep so much in reserve. And because they didn't need to keep so much in reserve, and now they have these losses, what happened was that they reported this unrealized loss. The CEO came out and said, "Hey, don't panic. Everything's going to be fine. We're going to raise another, $2 billion to cover these losses." They weren't able to raise that money. In the meantime, he cashed out $3 million of stock on his own. Um, the board went ahead and paid themselves bonuses, knowing that the bank is going down the drain. And as soon as the market found out that they were not able to raise that $2 billion, all those uninsured deposits started panicking and started withdrawing their money.
So did just the reporting change from quarterly to annually, or did that actually reduce the amount of liquidity that the bank had to have?
No, that actually reduced the amount of liquidity. The banks did not have to meet those liquidity. So if they had under $250 billion in assets, they no longer had to meet the liquidity requirements that the larger banks had to meet. So they basically kind of went back to, being irresponsible.
Well, I'm a little bit more than halfway through this smoke, and man, it burns marvelously. It's a really good, clean draw. Really mellowed out. Still has a nice, mild pepper flavor, but still getting some really nice sweet and leather undertones.
Yeah, I'm kind of getting the same thing. I'm kind of getting the pepper in the back of my tongue now. Getting some leather, mellowed out, kind of smoothing out now. Amazing. It's a great smoke.
So all of the uninsured account holders went to the bank, withdrew their money, and eventually, they just didn't have the funds to cover it.
So the uninsured depositors started withdrawing their funds because they weren't insured, right? They were panicking. Oh my God, we have, millions and millions of dollars, and we're only protected to $250,000. Now, the bank that declared unrealized losses had to actually start selling those treasuries in order to pay back the depositors. So those unrealized losses started becoming realized losses.
Right, and somewhere around the 42 billion mark, they ran out of cash.
Correct. And what happened was that, if, one can speculate that if they didn't have to report unrealized losses, then would the market go into a panic, or would their depositors go into a panic and start withdrawing funds?
It would be interesting to have a discussion about what is the likelihood, like what you just said, if they didn't have to report that, what is the likelihood that we'd be in the same situation with them today? Would they have pulled through it? Would their strategy worked? It would be a hard topic, but it would be one that would be interesting.
Yeah, and I think also that reducing the regulatory capital requirements for a bank didn't help. Making them exempt from having minimum capital requirements, and you and I both know we've gone out to banks and gone out for loans, and the banks, when they go to loan the money, number one, we'll ask for a loan for $1 million. They'll give us maybe 70% loan to value, right? And they want us to bring in the 30%, the skin in the game. But when they go loan the money, for every dollar of depositor funds they have, they can loan up to 10 times that amount. So right off the bat, that ratio is too low. And then they don't even have to report that.
Well, and it doesn't appear that the Silicon Valley Bank was a big lender as much as it was an investor in long-term bonds.
True. True, they were not a big lender, but in general, um, if you there was an article out by MarketWatch the other day, and they identified 9 other banks which are in trouble, and because their uh, unrealized losses are so high that they may also go under. And right after Silicon Valley Bank, Signature Bank was the next one that went under.
So right before this podcast, Jay, you were talking about the concentration of credit risk, and I think that is probably something that diversity would have helped them in this situation.
Yeah, Robbie, when I go to get a loan, and let's say I want a loan based collateralizing my accounts receivable. Okay, so these are all the customers that owe me money, and let's say I have 5 customers, and each of them owe me 20% of my total accounts receivable. So the bank will look at this, and they'll look at my accounts receivable balance, and they'll say, okay, we are going to just completely subtract any money that is owed to you over 90 days because we feel that it's uncollectible. Okay? Again, it's conservative. It's being protecting the loan that the bank is going to give out. The other thing that they do is they look at the concentration of credit risk. So if my 5 customers all owed me 20%, it'll usually be okay. But if one of those customers owed me 30% or more of my total accounts receivable, the bank will discount that amount because they basically say that there's too much credit that I have given to my customer, to one customer in one industry. So if that customer went bankrupt, then we would have too big of a hit.
And I think that's the case for Silicon Valley Bank. They have a really high concentration in the tech world, and they seem to have been hit really hard with this current economic environment.
Right. And so the concentration of credit risk, and I think I read somewhere that over 70% of their customers were startups. Um, and some of the startups did great, right? Google and Netflix and all them. But when you have 70% of your customers as startups, your credit risk is concentrated in one area, and not because they were lending. One of the problems was that they weren't lending. They didn't have a lot of loans that would balance out their portfolio, like real estate loans or other asset classes, right? But the problem is that you have all these uninsured deposits, and these are all startups, and everybody starts panicking. Now, one of the things that we talked about was how do you mitigate that? And I can tell you from a corporate perspective, part of the idea of treasury management, right? So the treasurer in a corporation is in charge of managing the bank accounts. And what I used to do when I had large amounts of money over the $250,000 insured amount is you separate into different banks. You'll have 10 different accounts at 10 different banks to make sure that they get insured. The other thing that you can do is they could purchase overnight treasuries or 30-month CDs. And this way, even though you're not getting the 1% or a 0.5% interest rate, but the money is protected. It's insured by the federal government because it's a U.S. Treasury that you're buying.
Well, I mean, I think ultimately it's a very unfortunate situation. It does look like FDIC and the government's going to step in and make everybody's accounts whole. Looks like the investors are the ones that are going to lose out, and the people that purchase the bonds are going to lose out. But lesson learned, and hopefully you can avoid these situations. I don't know how you can. It made me look at my banking situation, and maybe will probably force me to open some additional accounts and just to protect myself in this uncertain time.
Well, when Lehman Brothers collapsed, Secretary Paulson, who was the Treasury Secretary at the time, refused to bail out Lehman, and basically said, "Look, you took the profits when times were good. You got to take the losses, or another bank has to buy you out." The Treasury is saying the same thing right now, right? President Biden came out and said the taxpayers will not have to burden this loss. We're not going to bail out the shareholders and the bondholders even. of Silicon Valley Bank. The depositors we will make whole. They're going to use a special fund outside of the FDIC $250,000 fund to make all the depositors whole. But this is just the tip of the iceberg. And, they said the same thing in 2008 when Lehman failed. And before you knew it, after the second and third company security, the companies that held mortgage-backed securities started failing, then the next thing you know, there's a government bailout because it was just becoming a domino effect.
It's scary stuff. Scary stuff. And that's why I like real estate. I like assets. Keeps my money working and maybe potentially out of trouble. Not that every real estate deal can't have its faults, but I do feel safer in those investments.
Well, we really hope you enjoyed this episode. And, as a little bit of homework, go look up the different types of asset classes. Go look up the differences between held to maturity investments, and go look up what the differences are in the requirements for regulatory for the banks, and just learn some more about it.
Click the links below, educate yourself, and smoke good cigars.